Good evening and welcome to RACQ's 101 Guide to Buying Your First Home. Tonight we're joined by 3 industry experts who will share their top tips for entering the property market during such turbulent times. Whether you've already got your pre-approval or you're just beginning to work on your savings plan, tonight's session should help bust the myths and make the whole process of owning a home that bit easier. Before I introduce you to our 3 guests this evening, I'd like to run through some housekeeping. On the right-hand side of your screen, we do have a Q&A section. Please type in your questions for our presenters throughout the webinar, and you can stay anonymous if you'd prefer. My producers Jess and Esther will be busy making these comments public and handling our technology throughout the webinar. We'll answer questions at the end, so please do submit them throughout so that yours stays at the top of the list. If you have any issues staying connected tonight, don't worry. We will be sending you an email tomorrow with a recording of the webinar and some extra resources in case you missed out on anything. This follow-up email will also contain a survey so you can tell us how we did and these extra resources as well. It's also really important to make it clear that any information shared tonight is under the general advice model. Our speakers do not know your personal situation, so therefore cannot provide personalised advice to you. Any response to questions or comments made tonight should be considered general advice, and we encourage you to seek independent advice if needed. Now, I'll briefly introduce our 3 guests before we move into a guided Q&A and then audience questions at the end. Our first guest this evening is Strawn Taylor from Genworth. Genworth is a leading provider of lenders mortgage insurance in Australia, a scheme that many first home buyers use when they aren't able to reach a 20% deposit. Strawn's team is committed to helping first home buyers live the Aussie dream in a responsible way. Our second guest is Eliza Owens from CoreLogic. CoreLogic is Australia's leading property price analyst company, and Eliza is their head of Australian research. Eliza and her team work day in, day out to analyse movements in the Aussie property market to provide insights about the best times to buy and sell and what's considered value for money in your preferred suburb. Our third guest is RACQ's very own regional lending manager, Chris Betts. Chris has worked in home lending for more than 16 years and knows his way around a home loan application. Chris tonight will share his top tips for making sure your finances are ready for approval and for ensuring you're buying within your budget. To kick off tonight's webinar, I'm going to ask our guests how old they were when they purchased their first home and how much their first mortgage cost. Strawn, I'll start with you.
Thanks and welcome everyone. I was 36 years old, which I just did a bit of research before this, and the average age of a first home buyer is about 34 to 36. So I was the sort of top end of that. 450,000, I think, and that was a 95% lend. I also obviously had to cover stamp duty and legals as well on top of that. But it got me into my first house.
Fantastic, Strawn. And how about you, Chris? Tell us a little bit about the first home you bought.
Yes, no, the first home I bought was I built first time round. So I built back in 1999 from there. So I was 26 at the time, if you want to do the math on that. But I did a 100% lend when the 100% lends were around in the day. So with the Divine and everything on those lines for about 125,000. Built on a block of land with my lovely wife from there. Didn't get any grants, however, because my wife had already built before with another partner. So it meant it knocked me out of the grants and from there as well. So just to show how those things work from there. And then sold that property, would have been 5 years later, for 300,000, just to give you an idea of how well the market can move.
Fantastic, Chris. That's really interesting to know. Now onto you, Eliza. I know you haven't yet bought a property due to the high prices in Sydney, but it's a bit of a different story in Queensland, isn't it?
Yeah, it's interesting actually. So I'm 29, so good to know that I'm not yet at that sort of average age where I should be expected to buy a property, I suppose, as well. There is a bit of saving that's involved with it. But I think one piece of data that we've looked at CoreLogic that's really helped me put home ownership into perspective is the fact that when it comes to Queensland in particular, we estimate that about 60% of, or about 2/3 of properties would actually be cheaper to service a mortgage on than to rent across the state. And that includes about 60% of properties across Brisbane, about 70% of properties across the Gold Coast, and a bit less, about 43% of properties across the Sunshine Coast. So for having a mortgage and paying off that monthly mortgage repayment, that can actually be less than servicing rent, which is really interesting if you think about your housing costs. And it's largely due to falling interest rates and the fact that servicing the cost of money has gotten much cheaper over time. So we've done some research around assuming a standard variable mortgage rate of about 3.7% as of September, and assuming a 10% deposit, so putting down 10% of the value of a property. We estimate that mortgage repayments for a typical house across Brisbane have come down from about 2,600 10 years ago to about 2,300 as of September 2020. So we've seen house prices go up, we've seen rents also increase, but with that mortgage rate coming down, it does seem more viable to service a mortgage than pay rent, particularly across units as well. We estimate that for a typical Brisbane unit, monthly mortgage repayments would be about $130 cheaper than servicing rent per month. And some of the suburbs with the biggest kind of discounting on mortgage repayments relative to paying a landlord include houses across Kilcoy, houses across Woodridge, and units in Oxley. There's some examples of where there's quite a significant discount. And the thing I think that's really interesting about that as well is that Southeast Queensland is a bit unique when it comes to Australia's major capital cities in that way. So if we look at Sydney, only about 9% of properties would be cheaper to service a mortgage on than pay rent. And for Melbourne, it's only about 11% of properties. So where it's about, 2/3 across the state of Queensland, about 60% in Brisbane, I think there's clearly relative affordability and a lot of opportunity for first home buyers.
That's really interesting to know. I rent myself, and I definitely rent because I think it's cheaper than servicing a mortgage, and it seems like this unachievable dream. So that's quite interesting to know that in some places, especially in Southeast Queensland, it's actually better to service a mortgage. Thanks so much for that, Eliza. So Chris, I know that many banks did see a decline in first home buyers during the initial COVID-19 lockdown, but we're now seeing a bit of a resurgence in applications. Is this true? What have you seen so far this year?
Yeah, it's true. It's been an interesting year. It's been, like everybody has said before in regards to it, and COVID's definitely had an impact. It's definitely impacted our southern states a lot more than it's impacted Queensland, which is good for us. So, and it hasn't seen us probably dip as much as what the other states do, although we did see a dip, quite a significant dip through that March to May period from there. But with the stimulus that's in the market at the moment, with the government, particularly around the building grant, there's a regional boost grant as well, which the state government put into play, and your FOG and everything else, that's all playing into now, particularly in that building market, to really stimulate some movement forward. And we're seeing quite an increase, particularly in that construction loan phase. There's a lot of stuff happening with land and people getting into the market for that building, and particularly that home building grant driving a lot of interest from there. And that's what we're seeing, a massive uptick in that construction arena from there. So it is bubbling along in Queensland itself, which Eliza will probably come in and say, but Queensland itself is actually probably holding on a lot better than most of the other capital cities by a long shot, and that's that southeastern corner. And we're seeing a lot of uptick in our regional centres as well. The regional businesses that I look after from North Lakes to Cairns, we're seeing some really good development going through, particularly in Mackay, Townsville and Cairns sites from there as that regional things. As a lot of people are also realising with COVID, if there's an upside to it, has displayed that we can actually work remotely and we can work from regional centres. So we're seeing a good uptick in those areas as well, and they've been kind of kicking along nice and strong without very much a slight, that's probably what I call a slight delay in the market, but everything is moving forward quite nicely and at the moment, and we're seeing quite a good activity across the board.
That's really interesting to see, and I know that it's definitely been quite a common theme of people moving out of city centres because of COVID and realising they can just work from home or work from the beach and really change their lifestyle. So that's really interesting to know. Thanks so much, Chris.
That's all right, no worries. I'll just quickly say the Sunshine Coast market in particular is absolutely going gangbusters for us at the moment. Yeah, my lender there is actually, I've had to put another lender in there because of the amount of demand.
Wow. So, wow, and are you seeing a lot of people moving out of Brisbane? Is it new people moving to the market?
It's a combination of people looking at probably doing either the sea change or tree change environment. From there, there's a lot of stuff also happening from down south. There's a lot of property being bought sight unseen as well, and that's driving another market that's sitting in there. It's also driving a bit of a demand shortage from there. So it's definitely a more buoyant market than you'd appreciate, than you might think. So.
Yeah, I know, as Eliza was saying just before we got on this call, that they've just seen a huge uptick in new properties listed today in Melbourne, because now you're getting to have actual physical inspections. So it's really interesting to see what that movement will be in the coming months as, you know, borders change and people evaluate where and how they want to live and work. So that's really interesting. Now, Strawn, we know that LMI is popular with many first home buyers because that 20% deposit can just feel quite insurmountable at times. But would you be able to provide us some context around who's eligible, how it works, and really just what it's all about?
Sure, Claire. Actually, before I start, Chris, I've got an investment property on the Sunshine Coast, so that's great news. Okay, LMI. All right, let me provide a little bit of history and context first. So about 55 years ago, if you wanted to buy a home, so about 1965, you had to have a minimum of a 20% deposit, all right? And you also had to be with your lender for many years to prove your ability to save money. And it was quite restrictive. And so what the government did is they created an entity called the Housing Loans Insurance Corporation, that would insure lenders against loss and therefore allow them to actually lend above 80 and therefore open the housing market up to a lot more prospective buyers. Okay, and so the LMI essentially was created. And the thing to note is it actually covers the risk for lenders. So it's insuring lenders, but what that does is allows lenders to borrow more or a higher amount to prospective borrowers so that they can buy their property with as little as 5% deposit plus costs. If you fast forward 55 years, that HLIC company became Genworth, and we're publicly listed. In terms of saving to buy a house, without LMI, lenders generally still require a 20% deposit. So that's an option to save the 20%, but that can take you 5, 10 or more years. You can use the bank of mum and dad to assist with the deposit and or provide a parental guarantee, but that does put your parents in financial risk. Or you can use LMI, which is save 5% and plus costs. So don't forget you've got stamp duty and legals and things like that to cover. Now there are some grants as well that can help. Or you can use the government's first home loan deposit scheme, which is new, but again that's limited and not everyone passes with that. Currently, what we're seeing, about 66% of first home buyers who are looking to buy use LMI. What that does, it just gets them into their house sooner. In terms of eligibility, generally, if you are approved for a home loan, you'd be eligible for LMI. Right? So as long as you pass muster with your lender, then generally the LMI provider will also be able to write the insurance for that loan. And basically you just look at you talk to your loan manager, and they can usually talk you through that process. So hopefully that gives you a bit of an understanding of LMI.
Yeah, absolutely. Thank you so much. Now, Chris, on the topic of applications, what are the 3 most common mistakes you generally see first home buyers make in this process?
Yeah, in this process, I'll probably go with, there's probably 2 major ones. I'll go from there. There's probably a third minor one. But the first thing I stress to first home buyers, and it's also relevant to existing home buyers, is making sure that they're not going beyond their means from there. And what I mean by that is, it is quite, Eliza touched on it before when she was saying that around, in particular in the Brisbane market, it is better to sometimes have a mortgage than it is to pay rent. And that's probably the very first guiding line I give to any advice to any person that's looking to get into the housing market, is around, what do you pay now for rent? What is your lifestyle? What are you comfortable in your lifestyle? Now, this is to be thinking essentially is you need to have a budget. You need to understand your lifestyle. You need to understand what you want to get out of life and what you want to get out of a mortgage versus rent, or how your accommodation is working for you at the moment. And my biggest advice is making sure that when you take on, there's no good taking on a very big mortgage if you're going to live on baked beans. From there, because it is a trade-off from there. So the very first step is to go, rightio, I encourage everybody to go to any of the bank's online calculators, the RACQ ones, all the majors, all have online calculators. But the very first calculator I encourage everybody to look at first before they start anything is the repayment calculator, not the borrowing capacity calculator and not the borrowing cost one, which is the second one we go to, which is part of the second, making sure that we've got enough to be able to start the process from there. But making sure that they understand what their lifestyle needs are, what their goals are and what their aspirations are, go to the repayment calculator and work out what a repayment of a mortgage is going to be. And I encourage you not to do the discounted rate from there. Do a rate. Now all banks assess what do they call an affordability rate. It builds in a buffer zone, which is prudent lending things. But I'd add 2% to your special rates, or sit around that 4 to 5% if you want to just have a guide on there. Do your repayments to that over a suitable term, how long you want to pay the mortgage off for and how quickly you want to get rid of the debt and things. And if that's at your rental income or below, then you're in a very good space to start with, because that won't impact your lifestyle. And that's the key component from there. If it's above, then you really have to be looking at your budget. And I recommend going to moneysmart.com, which is the government budgeting capability. It's got a great online budgeting calculator. I encourage people to do 2 budgets. The bare bones budget, all right, this is a budget that you live but you don't live, all right, but you know that if everything happened and you tightened your belt to its maximum tightness, that gives you a line in the sand, because that's what you know, that's what's to exist, not to live from there. And then do a realistic lifestyle budget from there, and then from that work out what your disposable income is, or your rental income, or rent, or what can go towards a mortgage. Now if you do your mortgage repayments at that 4 to 5%, from there, and it's coming up higher than what you're paying in rent at the moment, then you can look at your budget and go, okay, what goes? What's going to give? And what am I willing to sacrifice to be able to make sure I can handle the mortgage from there? And that would give you a really good line in the sand to start with. And that's the very first thing to do particularly if you're looking to get into the market and where you're sitting in those budgets. If you're really keen, do 3 budgets, but most people aren't that keen in the scheme, and just do your budget as of today. It might scare you. But yeah. So that's the very first things around that. Around that, then you use those calculators again. There's always a borrowing cost calculator. So I'd encourage you to use those, because they give you what your actual costs are. As Drauna said before, around there, it's around LMI definitely helps you out with in getting you in the market and getting you in that door. But there are some additional costs that you're going to have to be aware of, and depending on where you are and how much you're borrowing and what kind of property you're borrowing, and if you've borrowed before, there's a whole heap of rules and regs in there. Depends on how much extra you need to have in your kitty from there. So you might have your 5%, but you might need the extra money for the LMI. You might need extra for stamp duty, transfer of land, registration costs. There's a whole heap of other stuff that you need to be aware of to make sure that, because all of those costs, technically you could probably put in the loan, but they don't add value to your property. So you're not going to actually get any, you can't actually really borrow for them. It's a neutral play from there. So you need that up front as well as your 5% deposit from there. And that's where people come undone a bit. They've saved really hard to get their 5%, but they haven't allowed for that extra bit from there. So that's that extra bit.
That people get caught out by. And I guess you've also got to think about things like moving costs. You're going to need to buy new furniture or relocate, and insurance and all of those things that you just don't think about when you're just wanting to get that deposit saved.
Yeah, and that's the other thing too, is the ongoing cost of the property and the maintenance. Units are a classic example. Some come with very low maintenance capabilities. They could be just a small strata, they could be things, or you could have your big body corporates, and because the facility has it's got gym facilities, it's got pool facilities, it's got everything for you, but your body corporate's going to be a lot higher in those cases, because they've got to pay for those facilities, they've got to pay for the maintenance of that, and you're doing that as a collective across there, plus you've got sinking funds and all those kind of things that come with it. So, and then that's a trade-off against looking at, do you want to buy a standalone, because there's different costs there with your rates and things. So it is around understanding the property you're looking for, and understanding which market you want to go into, and then understanding what that ongoing upkeep is all about from there. And probably the third bit of advice, which is advice, but my advice is, don't go for the mega McMansion. All right, stay within your means and build build your equity, build your wealth, as they're trying to essentially end up on the, like I said, the baked bean diet, which doesn't help anybody.
Yeah, absolutely. It's no good having a fancy front if you're living in the dark because you can't afford your electricity bill. Absolutely, that's fantastic advice. Now, I know we've heard things like, using Afterpay or Uber Eating every meal doesn't look too great on your bank statement. Can you give us a little bit of insight about what people should be looking out for when they go to look at their expenditure?
Yeah, look, it's a really interesting one, and over the years, lending has changed quite drastically. Storm was going back to 1965 and having 20% deposit, and then through the 80s and through the 90s and alike, lending has definitely changed for what it is and how it's done. It's definitely back in the consumer's hands. It used to be you had to get in your Sunday best. If you talk to your parents or the former mature people on the phone, you used to dress up in your Sunday best and you'd go see the bank manager, and the bank manager would make a call pretty well on how you look when you walked in the door as to whether you're going to pay back the debt. That's the lending of old. Doesn't happen nowadays, people. Let's just be fully aware of that. There's a whole heap of rules and regs in the space of it. But now in the current day and age, we've got responsible lending, we've got a whole heap of stuff. The banks are very, very cautious around making sure that you can afford the money that's been given to you to be able to facilitate purchasing that home and their things. Now, things like Afterpay, your Zip Pays, there's a couple of other varieties I know my 19-year-old daughter uses from there, and we have chats all the time about it. It's fine, but you are borrowing money from your future, and that's probably the best way to look at it. If you're borrowing money from your future, then I would argue you're not having a really strong savings pattern at the moment. Now, there are people that do it very effectively, and that's fine. And from a banking viewpoint, if we can see that done effectively, it doesn't have any impact. It's when it's done ineffectively, and I'd probably use credit cards as a probably really good gauge of that. If you've got credit card debt that you're not paying off every month, that essentially becomes, a term calls that hardcore debt, or a bank calls that hardcore debt, which means that you've lived beyond your means to get, and you might have got there for some whatever reason, but you've got to be really careful. If you're saving at, well, savings rates are between 1% and 2%, and you're paying 20% on a credit card, then you're out of whack. And that's getting that budgeting right and getting that advice right and making sure you're getting rid of some of that short-term debt from there and going from there. The key equation, and this is what I teach lenders, and this is what I definitely help when people are getting in the market, is you've got literally income equals savings plus expenses and liabilities, your debt. So that equation should always equal. And if you're not saving every month, then you know you've got something you need to do. And essentially that's going to your budget and understanding your budget and understanding where can you get those savings from to be able to do things. And that's what banks are looking for, is that savings history, that capability to be able to repay the debt. Now, rental income helps with that because you're paying that commitment all the time. So that's a really good thing from there. But the catch is then you've got to build a deposit and things. And you've got to make sure the Afterpays and Zip Pays, although convenient, aren't eroding your actual budgeting and you're not borrowing from tomorrow to pay for today.
Excellent. That's really great advice. And look, if someone does have that issue with their expenses and they've gone in for approval and they've actually been rejected, what's the process from there on? How do they get back in the game and bounce back from that?
Yeah, look, it's a really good question. And the thing that I'm very passionate about is it's not today, but it is tomorrow. All right. So it is around understanding that. If you get a really good lender, and it should be a partnership with your lender, and it should be a nice, honest conversation. And that's the key component. It should be an honest, good conversation, not some things around where you're at, what we need to do. And a good lender should be able to point anybody in the right direction as to what they need to do to be able to get that in order from things. It will all still fall back into a budget. The things that's where you've got to understand what's coming in and what's going out, and what can be tightened down on and what can be things like it's the likes of even down to, do you really need the Netflix for 4 people in your house? Can you run on 2? Do you need KO? Do you need the Afterpay? Do you need all those things? But this is your trade-off for lifestyle. So you've got to think. So again, back to a good detailed budget, have a look at it, understand it from there, and then put a plan in place, put a goal in place, and like everything else, do short-term wins. If you've got things, a good lenders will be able to step you through how to get yourself into a better position from there. And it is around, generally, if you've got some unsecured debts, getting them all in order, getting rid of the smaller one first, and building your capacity up from there. And at the same time, working out a savings plan or a savings program to get you to the deposit you need, and away you go.
Absolutely. And I think your comment about how it's more about finding a partnership is really important, because there's so much competition in the market right now. And you know, even though our parents or our grandparents might have been able to walk in in their Sunday best and get approval, now it's a bit of a dual thing. The banks have to prove themselves to you for you to actually want to lend with them. And so, yeah, it's really important now, I think, especially for first home buyers, to really shop around, find someone that you click with, find a bank that you think is going to do the right thing by you and look after you in the long term.
I couldn't agree with you more. I think it's a very important. This is a journey, and it is about making sure that you're off the right start, and you trust the things. The bank should be a trusted advisor in your circle and should steer you in the right direction.
Absolutely. Well, thank you so much, Chris. Now, Eliza, for our last question before we move on to our audience questions, so just another plug, if you've got any cues, put them in the chat. We do talk a lot about this phenomenon of spring selling season, but is this really when it's the best time to buy or sell? You know, what kind of pricing factors should people be looking for when they're wanting to purchase?
Yeah, so typically between the end of September and the end of November, we see that new listings coming to the market will rise by about 11%. So that means that more people are putting their properties on the market during this period, and total stock, everything sort of sitting on the market, will be at the highest level, usually historically, towards the end of November. So that's across Brisbane. And spring's selling season can be good because that high level of stock means you have more variety, but it is also a time where a lot of people are buying as well. So even though there is more stuff to choose from, you might find that you actually have more competition around that. At the moment, as we are through COVID, we found that social distancing restrictions that happened earlier this year made sellers very cautious about putting their property on the market. And as a result, we've seen that stock levels have been really quite low. So, you know, relative to the kind of demand that there is, we estimate that there was about 17,000 properties sitting on the market for sale over the past month. And that might sound like a lot, but that's down from 21,000 in the same period last year. So things might get a little more competitive. It just sort of depends on the buyer appetite. And I think with record low mortgage rates and a lot of incentives for first home buyers, such as the first home loan deposit scheme, we might see competition among that first home buyer cohort is a bit stiff at the moment.
Absolutely. I know I've got friends who are out there at the moment looking for properties, and they're going along, and there's already been 8 offers that morning before inspection. And yeah, it just seems like it's really ramping up in Brisbane. I know we've seen a few reports lately in the media about house prices are starting to spike in southeast Queensland. Is there any kind of truth to that? Should people be racing out there to try and find their perfect home, or just kind of waiting until the right home for them becomes available?
I mean, I think in terms of the price dynamics, it's really different depending on where you look across the southeast Queensland market. If you think about inner Brisbane units at the moment, we've seen them fall by about 5% in value since the onset of the pandemic. And that's because that was the market most exposed to investors, and investor participation is very low. And it was a market that saw new housing demand from overseas migration. And obviously with the international borders closed, that's created a bit of a demand shock. Meanwhile, in lifestyle areas by the water, you know, as Chris was saying, the Sunshine Coast, we do see that prices have actually risen since the pandemic. But the thing about property purchases is that it can be really exhausting, and I think perhaps a bit pointless to try and time the market by a day or a month, you know, when you think you're going to capture a couple of months of strong capital growth, because especially if you're living in it, this is an asset that you're going to have for, you know, potentially decades. And the accumulation of property value happens over a long period of time. There are fluctuations within that. So I think, you know, just echoing what Chris was saying about buying within your budget, if it's something you can afford, if it's something that might even reduce your housing costs over the long run, then it can still be worthwhile to go ahead with, rather than freaking out about what's happening in the economy.
Yeah, exactly. And I guess probably another piece of advice is, if you've got your deposit saved, you've got all of that ready, you don't want to rush into a home you're not happy with. So, I think it's important people don't feel pressured to go out there and put an offer down just because everyone else is.
Absolutely.
And I can definitely feel like it if you're in a very competitive market. So thanks so much to our panel for answering our questions so far. We do have a few audience questions, which I'm going to get to in a moment. You will see on the screen shortly. Now you'll see it. Thank you, Jess, for your tech help. This is where you can find some more information about home loans, managing debt, budgets and savings. If you pop along to our Financial Wellbeing Hub, we've got a whole lot of videos, downloadable resources, lots of interesting things you can find to help you build that deposit, build your credit history, make sure you look great to a bank, and also make sure you're making a decision that's right for you in the long term, and you're not putting yourself at risk of sitting in the dark eating beans. So I'll go to audience questions now. We've got one from Emma. Once we've saved enough for a deposit, what's the first step we should take? Is it talking to the bank or a mortgage broker? This one's probably for you, Chris.
Yeah, so well, it's a pretty. Once you've saved enough of a deposit, I'd still encourage you to go and double check and make sure you understand where your costs are, because you add that to your deposit for what you need. Across the board. When it comes down to a bank or a broker, that's real and truly personal choice from there. So both have their pros and both have their cons from there. A bank is, if you've got a long relationship with the bank, then it is around, I'd probably engage them first because they have history with you, and that does help in an application. There's no doubt about that, because they can see your savings patterns, they can see everything coming in and out from you, so that still definitely plays into it. And the way technology works nowadays is that's quite good for them to be able to. It's a lot easier to do that. A broker, however, gives you variety of things and maybe an element of convenience in there, although most banks now operate a very strong mobile fleet or a very strong digital after-hours offer. So very unusual for a bank not to be able to service you when you need to be serviced, which is definitely the big change from if you go back from the 80s and 90s, where you had to get to the bank manager and you had to be there in your Sunday best, and if you didn't get there at 2 o'clock, that was
weekday.
Yeah, that was the end of that kind of things. Whereas nowadays the banks are very proactive and very much keen to get out to see you and engage with you and understand that. So that's where that's where a really good broker sits as well from there. And a broker can give you a lot more variety of what's in the market to allow you to go from there. The difference being is that sometimes the bank has a bit more of a vested interest to get you to help you, particularly if you're on that fringe stuff, or there's something that's not quite sitting right, or you need a little bit of extra help and they need to engage with their internal departments to make sure the deal can get across the line. A bank generally is a little bit better than that, than the broker side of things. The broker side of things will kind of shift around until they can find somebody that says yes. So that might not be the right deal for you though. So that's the bit you've got to just watch with that. But I'd encourage, particularly for first home buyers, is probably just go through a pre-approval process. Things just to get you feel and understand what you're going to be required to get there. It also helps you, gives you a bit more confidence when you go into the market from there. Now, all the banks and brokers and all that should have the capability to give you property reports, which is what RP Data and CoreLogic and Eliza can expand on that, but they all should have that capability, which means that you can go into, and I'd highly recommend this, before you go to a property, get the property report. At least it puts you almost on an even keel with the real estate agent, and you actually know a bit of history on the property. You understand where the range is for that property and where it should be things. You also understand a bit about that suburb and things. So do your research and understand where you're going from there. So that's probably the key thing. Now, a good broker or a good banker will give you that before you land. Okay, and start going hunting for properties. Also, if you're looking for, and what's really keen nowadays is if you're looking for in regions, if you want to get to a certain school, if you've got children, or if you want to see certain public transport, if you work in the city and you want to make sure you're on a corridor that's going to allow you to do all that, that's where a good banker or broker or lender will guide you and help you and give you the data to make sure you make an informed decision, along with giving you that pre-approval, which gives you a bit more confidence when you go into the market and takes away a little bit of that angst and that anxiety.
Fantastic. Thanks so much for that, Chris. We've got a question here from Corey. He says he's currently debt-free, rent-free, and has thus far avoided signing up for a credit card. Bearing this in mind, what are some ways that they can demonstrate sound savings habits and boost their credit history and readiness for a loan application?
All right, this is quite a common question, actually. It's quite an interesting one from there. So Australia operates, it's currently in transition. It operated on a negative reporting environment. It's gone to a positive reporting environment. But essentially it meant prior to things, it meant that if you had lending elsewhere and you'd done a heap of credit inquiries, it actually worked against you. We're moving to an environment now where we recognise that and we understand that, and then we can actually see really good repayment history. Doesn't mean you need to go out and get credit. So my encouragement to you is don't go sign up for a credit card unless you want a credit card. Don't do it to get a credit for things. There are other things that are actually driving your credit file from there. Probably the two main ones is your phone. Is there, and any utility bills. They all have that same capability and they all give that same line of sight from there. Savings is quite simple. Just make sure you're saving in your name from there. That's a really key one. That might sound like a bit of a quirky one, but for an example, my daughter at the moment, she's on a budget and a savings because her dad's in finance, but the savings account's actually in my name. From there. So at some stage, I need to be comfortable that things. She's 19, and she's as we learn and we grow from there. But that money, even though technically it's hers, it's sitting in my account. So technically speaking, it's mine. From there. So it is around making sure that that savings account's in your name, okay, and it's sitting in a bank too. Keeping it under a lock and key in a safe under a pillow isn't quite doesn't show any history, doesn't show anything along those lines. Banks need to be able to see that history and be able to see that go through, and particularly from an LMI point of view, genuine savings and everything else, which Strong can definitely cover off in a bit more detail around that, what is required there to be able to demonstrate that. But you don't need to have credit to have good credit rating is probably the end subject for that.
That's really good to know. And so, for example, I'm assuming perhaps this person might be living at home and might not be having any utilities bills in their name. Is there any other way they can prove they're contributing to the expenses of a household rather than having their name on an actual bill? Or do you really need to have a bill or a piece of paper that says, my name's John Smith and I paid this amount of utilities?
No, not necessarily. The tech's quite impressive nowadays. We do, and personally, and what we do on our things, we do a data scrape. We can scrape the statements, and we can actually identify payments that are going out. So we'll be able to identify payments that are being contributing to things. Doesn't necessarily mean that the bill's in their name. The bill's more around just making that credit file, but actually paying and making good on repayments, we can track via statements, no problems at all. All right, things that the world of electricity, the pay wave world that we live in now, and we're to be COVID compliant, cash is well and truly not the preferred payment method. Everything is electronic payments, and with the pay ID and the capability of paying stuff in real time, which will only improve over time, means that it's all digital things, which makes it incredibly trackable and easy to be able to validate.
Fantastic. Now we've got an anonymous question here. What does it mean for the buyer when there's more competition? What can they do to really prepare and get ahead? And I feel like, Eliza, this might be where your advice around getting that property report and, how do they actually access a property report or a region report? How does that whole process work?
Yeah, so I guess just in terms of understanding your operational environment and knowing what market metrics to look out for to understand, is there a lot of competition right now, or do you actually have some negotiating power? So we have suburb reports that you can get on the CoreLogic website from our report store. And that has metrics in it, days on market and what we call vendor discounting are particularly helpful metrics. So days on market for a suburb is the typical amount of days that a property spends from the first day of being listed to when it sells. If days on market is rising, that tells you that there's probably less buyer demand and you'll have a bit more negotiating power. Whereas if days on market is shrinking and it's really tight, that's suggesting that stock is moving very quickly. The other metric alongside that is what we call vendor discounting, and that is the difference between the initial listing price that the seller will ask for and what they end up getting for it. So we analyze that and how that gap is kind of changing over time as well. And usually when days on market is rising, vendor discounting will be getting deeper and you might get a bigger discount as well. So keeping across those statistics is important. I will say that with the introduction of the first home loan deposit scheme, a lot of the grants we've seen additional to that are in the new home build space. So theoretically, that shouldn't be adding to demand for existing stock. But I think with the first home loan deposit scheme, the fact that investors are dropping out and first home buyers are very prevalent, there probably will be a bit more demand among that segment right now. But again, you know, it's not necessarily about rushing things. You can take your time and find the property that's right for you and the right kind of price for you. I don't know if Chris has got any better advice about how to sort of prepare yourself as a potential buyer as well.
Oh no, I think if you put it. Oh, do you want to speak, Strong?
Oh, sorry,
no,
Strong.
you go, Chris. No, it's okay. You go, Chris. I've just got one other thing I'll add. Go, Chris.
No, all I was going to say is I think the property reports are incredibly valuable in the suburb reports, particularly around, and as you said, I think you've highlighted some really key points there in regards to how long properties are staying on the market and that vendor discounting, because they have an inverse relationship. So it is it gives you a really good indication of where things are at across the board. And again, a decent lender will help you with that and get you on board with that as well, which is good from there. Go for it, Strong.
Yeah, I was just going to add that, like, do your research. There's so much information out there, and that you can tap into. The other thing I'd say is, certainly in New South Wales, auctions are quite a big thing. So, if you are looking to buy and there are auctions, just go along and attend, and just get comfortable with the process of a sale, and just see what goes on, because you learn a lot just by being there too, if you have that opportunity. So sort of get out and amongst it, and also talk to real estate agents. You know, that's what they're doing all the time, and they've got a lot of information for you as well.
Absolutely, that's really good advice. And I guess, you know, putting down your first offer or going along to these things, it's really about experience. The more you go put yourself out there and the more information you try and research and find out, the better your chances might be of finding a place that's right for you at a price that's right for you. I know we do have an interesting question here from somebody who's talking a little bit more along the lines of refinancing. So, you know, you're starting your home loan journey, and we've said you should look for a relationship with your lender and to shop around to make sure they've got everything you need or want. But there are a lot of incentives out there around refinancing. So, you know, is it a big deal if you change your home loan over to another lender? Is that something we see a lot of people doing? And is it actually that easy to change? Probably a good question for you, Chris.
It would certainly. So refinancing, there's a couple of things with refinancing, and one is, and the advice always is only refinance if it's going to put you in a better position. From there, and I would engage your current lender first. From there, if you're looking at the reasons as to why you're refinancing. So some will be price driven, some could be service driven, some could be those kind of things. I would always give the lender the opportunity to be able to rescue, I suppose, or understand you better from there. But if you feel that you're not being listened to and you haven't been heard, in that case, well and surely the power is with you to be able to do that. The real advice is I wouldn't do it until you had 20% deposit from there, because if you pay lender's mortgage insurance, you'll end up paying it twice, which means you pay two different banks to protect them in regards to the insurance. So that's probably not a wise decision, and most institutions shouldn't actually do it. It's got to be a benefit for you from there. So you could really weigh that up. From a refinance point of view. I also understand your current debt and what kind of product it is and whether it's servicing your needs. And again, that's engaging back with there, because there's differences between a basic loan, a loan with an offset, a split facility, and a fixed facility from there, or even a line of credit, which are pretty rare nowadays from there. So it's around really understanding the reasons why. Just be careful of any introductory offers that are sitting out in the market, because they do have might have a few little extra conditions that you might not be aware of. So always do your homework and do your research with them, and understand the cashbacks as well from there. I appreciate they're pretty attractive in the market. Some will work, some won't work. You might end up in a product that won't actually do what you need to do, and the goal is for you to actually own your property, and that's the thing. So you're better off doing that in a partnership, and hopefully a long one, and you get looked after. But if not, then the consumer always has the right to move.
Excellent. Thanks for that, Chris. We've got a question here from Ash, which is, how important is it to make sure your credit rating is up to date? They did a credit report recently, and it had shown that they had no inquiries against their name. However, they have had an overdraft in the past and 2 different credit cards previously, but they're now paid off. Is there a reason why this wouldn't appear on a credit report?
That'll be me again. From there, so credit reports have a life. So if you went back far enough, they generally run 5 years in the things, and lenders look at the last, as a general, last 3 years in the scheme of things, but they might ask questions go back 5 years from there. So again, around credit ratings and everything else, yes, I do encourage you to keep a really close eye on your credit ratings. It's a really good place to make sure that there's no fraud being like identity fraud is a really good one to pick up. Somebody's stolen your identity, so I'd always recommend doing a credit rating, because if you see something that's an issue with that, then you can address it from there. Thanks, it does flag that. They're rare, so don't want anybody to panic, but it is a good way of making sure there. But it is your credit file. It is very, very important that you understand that and you own that, and it's your responsibility. So you can do a credit check on you, and there's a scoring system that goes with that, and you want to be probably in that 700 to 800 and higher bracket across there. When you start getting below those numbers, when there's something, either you got a heaps of credit, or you've missed some payments somewhere, or something along those lines, or there's something there that shouldn't be there, which is also possible from there. So it's about making sure that you do that. I know personally, when I first entered the world of credit, I had 3 credit files, because apparently when I say bets, it sounds like vets from there. So I had a credit file with VETTS, and I had a credit file with BETTS, and then I had another one which was a bit superfluous and to the side. But 2 of them were actually running 2 lots of credit that would both belong to me. It didn't get picked up until my 3rd mortgage, just to give you an idea from there. So it is a very good idea to run that and to do that. Vita is the main provider, or Baycorp, and you can do some Google searching on how to get your credit report. You can get it free, or you can pay a fee if you want to get it quicker, and those kind of things as well. But I'd encourage people to do that on a semi-regular basis.
Absolutely, that's great advice. Now we do have another question here, which is probably for you, Strawn. So this listener is asking, are you better off entering the market earlier with a 5% deposit, or waiting until they've really got that 20% deposit? You know, looking at those costs about rent, you might be spending an extra $80,000 to $100,000 over those 5 years in rent, as well as the insurance and other payments you might have. And looking at LMI, is there any kind of evidence you've seen that shows that, you know, if people are ready to go, LMI can really give them that foot in the door rather than waiting until they've got that huge deposit?
Yeah, very good question, Claire. And we actually have what's called a buy rent calculator on our website that people can look at, and I can shoot you the link after this, which allows you to play around with you know, what you're spending at the moment, how much you're saving, what interest rates are, and also what the property price growth is. Now, property prices do go down, right? They go up and down, but over time they generally go up. And I think Chris mentioned how much he made, you know, in his first house from, you know, building that and then trading out of that. And look, depending on where the market is, you can make a bit, but it is possible to lose money. So you just got to take a long-term view in terms of property. So look, if you've got 5% and you've got you know, your expenses covered that Chris did allude to, and there's some you know, good options for you in the market, and you know, you've looked at LMI and you've spoken to your lending advisor, then by all means, I think that, you know, that's what LMI is there to do, is to help you get into that market sooner. And as I said, look, it can take you, you know, depending on your income and what you're looking to buy, you know, it can take 5, 10 or more years to buy to save that 20%. And you know, the market's going to move over that time, so it's definitely an option to look at. And you know, we've put you know, over the length of time that we've been in business, we've put millions of people into houses earlier of that.
Absolutely. And look, I have heard that there's a few people who might be exempt from having to pay LMI. Is there any credit to those? Sometimes you can see on Google that people like physios or other healthcare workers can have less than 20% deposit but are actually exempt. Can you talk to that a little bit?
Yeah, very much that's very much the lender's prerogative. It started with surgeons, with doctors. And I think one of the majors might have been Westpac, were the first into that space, and this is over 25 years ago. And yeah, again, they're just looking at risk profiles of particular cohorts in the market, and they saw that was a reasonable risk profile where, as an offer, they said that they would waive LMI, and usually that's to 85, sometimes 90%. But if they go over that, then they obviously pay it. Some lenders pay the LMI themselves, so it's still insured, and there's a whole lot of, you know, complex capital things that go on the background, which is why there's quite a big market for it. So look, yeah, depending on the industry that you work in and your job, by all means, ask your lender, and if they've got that credit policy, not all lenders offer it, but some do.
Okay, that's really good to know. So it's really about having that conversation with your lender about what's right for you. Now,
Absolutely.
Eliza, we do have a few questions coming through here about some key features to properties that make them more serviceable to purchase than rent. We've also got someone who's asked about what should they be looking for in a first home, which I'm sure is quite an individual response. But if we're talking about property prices in Queensland and where we're seeing movement in the market, are you able to shed some light on whether we're seeing more units? Is it new developments? Is it existing homes? Yeah, if you could just chat to that a little bit, that'd be great.
Yeah, sure. So it's always, I get asked a lot, where should I buy and what should I buy? And I always find it such a tricky question to answer because, I mean, the first thing I'd ask you is what do you want out of the property? Is it, if you're looking for capital growth, I can tell you some high growth areas, but you might hate to live there. I will say from that capital growth perspective, historically, looking at the very long term, so say 10 years annualized, we've generally seen higher growth rates in properties long term that have been closer to the city centre and have been houses. Mm-hmm. So, for example, Ipswich, even though it's seen positive growth on that 10-year annualised basis, the growth is relatively soft to what you might see in, say, Brisbane's east or something like that. So there are definite differences there for the capital growth. But if you can't afford a waterfront mansion in Brisbane's east, it's your first property might just be a unit somewhere because that's what you can afford. Again, I would say units have probably underperformed relative to houses just because of the high levels of supply that we've seen across Brisbane from around 2012 to 2016. And I'd say that for Brisbane, the key to growth is probably going to be the flow of people again who can sort of continue absorbing that unit stock. So it is a very personal thing, but yeah, from a capital growth perspective, it's really been houses which have held more value and some of the markets closer to the city of Brisbane. Additionally, Sunshine Coast and Gold Coast have performed very well over the past 5 years as well in housing stock. So I guess that's something just purely from the data. Now, good question about what kinds of properties is it when we're talking about those that are cheaper to service a mortgage on than rent. Again, it does come down to sort of the individual parameters of your property purchase, how much of a deposit you're putting down, how long the loan term is, what other costs are involved, things like that. But when we've done it on a scenario of, say, that 10% deposit with a standard variable mortgage rate of 3.7%, we've seen it is units where it's much cheaper to service a mortgage. And again, that's partly because prices haven't appreciated as much over time relative to, say, rents. The other areas that we tend to find the mortgage servicing is cheaper than rent tend to be those areas further from the city and some areas like Ipswich as well, for example. So there is certainly a bit of a trade-off there, but I would say for Southeast Queensland generally, because the price appreciation hasn't been the wild kind of booms that we've seen across Sydney and Melbourne, there are going to be more properties that you have that opportunity to reduce your housing costs potentially through taking on a mortgage over the long term. So it's just a matter of sort of doing that research on the property and I guess just understanding the individual costs that are involved for you as well.
Absolutely. And I guess it's also looking at how much of your lifestyle you're willing to trade off. And it's good to know that in Brisbane, there's certainly areas that are closer to the city where you still get that lifestyle benefit, but you're also still able to own your home. Look, we do have one last question we'll cover before we let everyone go for the night. And that is it possible to get a better mortgage rate than has been advertised? I think we've got quite a savvy negotiator on our hands here. What's the best way to negotiate with a lender? Is it purely about bringing competing offers from other lenders? Chris, how do we crack it with lenders?
Look, it's a really good question, and I'll probably want to expand it a little bit. Things don't get, like, rate is definitely important, don't get me wrong, but also making sure the product is the right product from there, and also package. There's a couple of things in that from there. So you'll find that most lenders now have a base variable product. They have a base thing, so essentially the no frills loan. It's definitely changed well and truly over the last 10 years, where a packaged loan would used to be the lead loan. It's now, the package loan is no longer the lead loan. It's the base variable loan is driving that. And you probably thank probably Scott Pape, the Barefoot Investor, for that. He's been the bestseller for a couple of years in a row, and it's definitely something he definitely highlights in his literature. So it is around understanding that. Most institutions, some of them do have the ability to move, some don't. Some put everything out that they can do straight up front. Some will have some in reserve. The key way is to have that conversation, have an open and honest conversation, understand the market, make sure you're comparing apples with apples from there. It's different for a bricks and mortar bank, so things to be competing with an online bank. There's a completely different cost structure in there, and a different service level from there. So understand what service level you're looking for, because essentially that's what you're paying for from there. So the answer is yes, always negotiate, always ask in the things, things, and then find out, and then also understand the product that you're looking at. One really key quick tip around that is offset accounts are a very good feature. There's no question on that, and they've been a very strong flavour for the last 10 years. However, there's now a decent price differential between an offset account product and a non-offset account product, a base variable, generally around that 15 to 25 basis points things. And you've got to be really careful with that, because that means you need to hold good funds in that offset account at all times to pay for that differential of having the offset account from there. So that's a really key thing, and it's something I really encourage you to sit down with. When you sit down with the lender, I'd be really making sure that you're really comfortable that they're looking at the right product for you, the right capability for you, and unpacking that for what you need, whether you need to have it in a package, which is essentially what are the other bells and whistles that come with that package. Do they pay for themselves, or are you better off being in a base variable? Do you need a surety around repayments, which is what your fixed lending will give you? Do you need to do a hybrid loan or a split loan to be able to drive that from there to get the best of both worlds? Because at the moment, if you look at the market, fixed rates are quite attractive, and they're definitely well and truly 30-year lows on fixed rates. We've never been in this position before from an interest rate point of view. And so we're well and truly at a different part of the cycle from there. So you want to look at that market from there as well. But there are always a few things around fixed lending. Make sure when you're locking in a loan for a fixed loan, that you aren't going to sell that property in that term. You aren't looking to pay off extra money, because sometimes there's a lot of restrictions with a fixed loan. Even though it gives you a really good rate, there are restrictions. So you need to be really careful and make sure that you're engaging with your lender or broker, whoever it is, and making sure that you both understand what your goals and your aspirations are, what the advantages are of each product that you're going for, and can you get the sharpest deal in the market. And away you go.
Absolutely. Well, look, thank you so much, Chris, Eliza, and Strawn, for your help tonight. I think it's really been quite a valuable session for our listeners. I know we did have one more question in there about some grants, but Esther has put a link in there which should hopefully answer that listener's question. Now, I'll just get Jess to switch to our last slide of the night, and we'll let you get on with your evening. So thank you very much for all your questions tonight and for tuning in. Do keep an eye out on your emails for that follow-up email. It'll have a recording of tonight's webinar, so you can watch it to your heart's content. It'll also have some extra resources for you. So we've got a first home buyer's guide that'll hopefully demystify some more of those concerns, and some information from Genworth about LMI and really breaking down whether it's the right choice for you. Do also keep an eye out on our Facebook page, RACQ Official, for the recording as well. Look, thank you very much for tuning in. All the best on your first home buying journey, and we'll see you soon.
Thanks, Claire.